So tonight we'll be looking at portfolio return and also be looking at portfolio risk. In our previous class, we looked at portfolio return where we have more than one. Discovered we need to have an understanding of single asset portfolio return where you just have just a single asset, and there are various ways to complete the return. Yes, because you can see question where you are not giving the return straight away. The examiner will want you to determine the return using either the simple average, the expected return, the holding period. So when we talk about portfolio return, just as a way to return is simply the total return earned from a combination of investments, that is assets, taking into account how much you invested in each one. So the basic concept is that instead of looking at one asset, a portfolio combines what several assets, e.g. shares in company, and so on and so forth. So the portfolio return is the weighted average of the individual returns, just as we looked at in our last class, where we say portfolio return is weight of asset A multiplied by return of asset A plus weight of asset B plus multiplied by return of asset B, and so on and so forth. So there can be a case of a single asset portfolio, and in that case, you can be examined or asked to determine the return. So where it involves simple average, where it involves single average, the question will not tell you using single average method, but looking at the information in the question, you should be able to know that you have to use single average. Now, what is this single average, or simple average rather? Simple average. Another word for this simple average is arithmetic mean. I believe you know how to calculate mean, where you have set of data 1, 2, 3, 4, 5, 6, and you're asked to compute the mean. What will you do? Is to have the whole set of data, divide by the number of occurrence. Divide by the number of occurrence. That is the simple average return or arithmetic mean. For example, when we talk about the simple average return, you'll be given past returns. You'll be given past returns. So you want to actually predict what the future or the now will be. So the average return involves treating each period equally. You can have period 1, period 2, period 3. All these periods are past, but you want to actually know what is the return, what is likely going to be the actual return as at today. So you can use the past data and look for the arithmetic mean, to be able to come up with a value of return. For example, you can have returns of over 3 years. You can have returns of, let's say, over 3 years. Let's come up with an example to show that over 3 years. You can have returns for, let's say, 210 to be less than 10%. You can have return for 211, let's say 20%. You can have return of 212, let's say. Using simple average or arithmetic, what would be your return? What would be your return as that now? Yes, you want to have an estimate of your return as that now. So what will you do based on what we've explained? It's going to be what? It's going to be 10% plus what? 20% plus what? plus 30%. You divide everything by what? Divide everything by 3. By 3. So what would be your simple average return
20.
based on this? A simple average return
20.
at
20.
20. Okay, that is 20%. 20%. Why am I bringing this concept? They might not just ask a simple question, but in a question, you might be required to use knowledge to solve the problem. So that is why I'm bringing it. A question where this knowledge is important. That is what. All right, sorry about the network. So, as I was saying, that there can be a question where you need this knowledge. And that is why I have to talk about this, so that when you see a question or I ask us to solve a question that requires this understanding, you will not say, how will I solve it? So that is why I'm bringing this up. So you can just be giving returns, historical returns required to determine the present return. What will you do? You add the data given to you based on the number of occurrence, divide by the number of occurrence. So the key concept about the simple average return or the arithmetic mean is that it is easy to calculate and it ignores the issue of trying to compound, trying to look for discount factor and the rest. So it's just a simple technique for short-term estimation, So that is one thing with the simple average. Now, the other technique that I put forth here is the expected return. Another word for expected return is the weighted average return. The weighted average return. We are used to this one. We are used to this one. Now, when we talk about the expected return, what we're looking at the probabilities of different outcomes where we have issue of risk and uncertainty. And when we're treating risk and uncertainty, I made mention that expected return can be computed using which formula? Summation P multiplied by R. Summation P multiplied by R. So in simple terms, expected return considers probability of different outcomes where there is possibility of risk and uncertainty. And we compute by saying that what? By looking at the summation, the summation of what? The summation of P of P multiplied by what? Multiplied by R. Now, what is P? P is what? P is your probability. P is your probability. And what is your R? Your R is your return. Is your return. For example, we can have a question in this form. We can have a question in this form. The question will not tell you using expected value, or the question will not tell you to use expected return. But once you see a question with probability and return, you should know that you have to use the expected return, expected value approach. You can have a question that involves scenarios. You can have where the condition is booming. You can have a case of normal. You can have a case of what? Of recession. Of recession. And you can have the probability to be what? To be 0.3 when it is booming, probability of 0.5, probability of 0.2. And you can have a return of what? You can have a return when it is boom of 25%. You can have a return of 15%. When it is normal, you can have a return of 5%. Now, if you are to use the expected return, what are you going to do? How are you going to get your return?
Multiply the probability by the return.
Yes, you multiply your probabilities by the return. That is, to be your expected return would be equal to what? For the boom to be 0.3 multiplied by what? Multiplied by 25, and what? Plus, for normal, it will be 0.5 multiplied by what? 15, and for recession, it will be what? 0.2 multiplied by what? By 5. So when you do this and add, what will be your outcome? What will be your outcome? 0.3 multiplied by 25. You should have 7.5 plus what? 0.5 multiplied by 15. You should have 7.5. Please confirm. And 0.2 multiplied by 5, we should have 1. So when we add up everything, 15 plus 1, this should give us 16%. Should give us 16%. So this is where expected return is required of you in a question to determine the return. Yes, the return. So this expected return is can also be seen as mean. Yes, in a way, that is R bar. You know, the mean is X bar in statistics. This also can be seen as R bar. As we move forward, you see what I'm talking about in a better way. So the concept of expected return is that it is forward-looking because it incorporates the issue of risk and uncertainty. You don't know what will happen. So basis of prediction is to use your expected return. This is one of the ways to determine your return, your X bar or R bar. Now we have another one which I put forth here, which I term as what? The holding period. The holding period. The holding period. This holding period, it applies the concept of percentage change. Yes, of percentage change. That means you have information about the past. Now, what have been the percentage change over time? Now, the holding period return, it measures actual return and it measures actual returns and over a specific period. Now, what are the components to compute holding period? You definitely have your return, your past return. You definitely have income. You definitely have price change, price in the as part of the question. Now, how do you compute your holding period? As I said, it involves the concept of percentage change. Your holding period return can be computed in this form. That is where you have P1, you can say P1 minus P naught divided by P naught divided by P naught. That is this P1 in this numerator, you can have an addition of income where, please take note of that, my statements, where you have income such as dividend, or where you have income in terms of profit, you add. But where you don't have, you make use of P1 minus P naught divided by P naught. Take note of that. What is P1? The question is, what is P1? What is P1? I'll define it now. What is P1? This is a form of percentage change. Percentage change. So when we talk about P1, P1 is what? Initial price. The price as at the beginning. Initial price. Rather, sorry about that. P1 can rather be, let's say, final price. Final price. That is the current price. Yes, can be the current price. And P naught can be the initial price. The initial price. That is the old price. You know, you can have new minus old divided by what? Divided by old. That is the percentage change. So you can write it in a way that you understand. So P naught is initial price. Initial price. So it is the new price minus the old price divided by the old price. You have your percentage change. So where the question is giving you return in form of income or dividend, you add to the numerator. Where it is not given, you ignore and solve by using these variables only. There's another way you can put this, but let's go with this for now. For example, let us show a simple example regarding this. For example, for the holding period return, you can have information such as bought shares. The value in which you bought a share can be let's say 100 naira, and you decided to give it out sold at what? At 120 naira. Now, is there any return dividend related to this? If yes, you have it. Dividend. The dividend, let's say, is 10 naira. If you are asked to use the holding period to compute, what will you do? What will you do? The holding period return will be equal to what? Your current or your final price is what? Your final price is what? Is 120.
120.
Your final price, because that is the price, the last price, 120 minus what? Your initial price is what?
100.
100. Do you have any income? Is yes. That is 10.
Yes.
Divide by the old value of 100. So for holding period, you apply this concept. And when you do this, what will be your return? What will be your return? This should be 30. This should be 30. Divide by 100.
0.3.
Divide by 100. And this will give us what?
0.3.
This will be equal to what? 30%.
30%.
Take note, where dividend is not given, you just solve, ignoring these aspects. Take note, I'm emphasizing, so that when I come to the big question. I will not get too much question. Where you are not giving dividend income or any form of income, you ignore and solve by saying 120 minus 100 divided by 100, and you get your percentage. You get your expected return. So this concept is built on the fact that what will be the actual performance? What will be the actual performance? And this concept is built upon the fact that what will be the capital gain or loss? What will be the capital gain or loss or income in form of dividend? So, and that is why you can see this aspect is coming here. It's coming. So, in simple terms, the simple average is historical. The simple average is historical in nature. That is the first one we look at. The expected return involves probability. The holding period involves the actual. So these are some of the ways you can be asked to determine return in a question. So this will just be like an additional information, not a full-fledged question. So you just need to apply this knowledge to determine your return. So take note of that. Take note of that. Now, if you look at the question I asked you to put in your notes, they are just examples to buttress what we've done here. Now, the first question I asked to put in your notes that I forwarded to the platform yesterday, that the question is what? That the information below relates to the mining sector of Nigerian Stock Exchange. We have year returns. We have year 2020, the return is 12%, 2021, 10%, 2022, 8%. From the above, calculate the expected return. So what will be the expected return in this case from my earlier explanation? The expected return will be what?
10%.
10%. That is, we add 12% plus 10% plus 8% divided by what? 3. Because this is historical. They're giving you past data. So you add the whole value, that is 12% plus 10% plus 8%. Divide by 3. Divide by 3. So once you do that, you should have what? You should have 10%. You should have 10%. Should have 10%. So this is one of the questions I asked us to write down in our notebook so that we'll save time. So the other question is what? The other question, that the information below the other question is this, that probability of return in Z equity stock is as follows. Possible return, we have 5% with a probability of what? 0.05, 8% with a probability of 25%, 10% with a probability of 40%, 12% with a probability of 25%, 15%. And Amadenike, you can mute yourself. So, possible return, 12% probability of 25%, 15% probability of 5%. Calculate the expected return. From what we've solved, the earlier example, can we solve? Which approach are we to use here? Since we have probability and possible return. So can you quickly solve? What would be, yes, so what would be your expected return? What would be your expected return? Still 10%. Expected return is still 10%. That is 5% multiplied by what? 0.05 plus 8% multiplied by what? 0.25. 0.25 plus what? Plus 10% multiplied by what? 0.40 plus what? I'm just showing this. This one is not what we are supposed to be doing. But I don't want
I
question when I move to the
my 9.95.
approximately 10%. That is 10% multiplied by. Then we have 12% multiplied by 0.25 plus 15% multiplied by 0.05. When you do all these, you should have the results of what? Of 10%. So that is what that question wants you to do. The question is in your book, forwarded to the group already since yesterday. So we have this question again, that Kemi stock is currently selling for 23 naira. It has the following prospects for the next year. Stock price 25 naira, dividend of 1 naira, probability of 25. Then we have 30 naira with dividend of 1 naira of 1.5, probability of 50%. We have 35 naira dividend of 2 naira, probability of 25%. Calculate the expected return. So based on this, what can we do? How are we going to determine our expected return?
I'm logging up.
The old price minus the current one, P1 minus P0 divided by P0 plus 1.
So we can say, let's start. Let's say we have S1. S1 will be equal to what? Based on our formula, we are
25.
working for 25 now. 25 minus what? The old
23.
23 divided by what?
23.
I think there is a dividend.
Yes, sir.
We add, the dividend is 1 at that point in time. So what will be your X? What will be your expected return?
13%.
Your return rather, not expected return yet.
13%. 0.13.
Okay.
Sorry,
13%.
sir. Please, I want to draw you back small, please.
All
Can
right,
I?
sir.
Okay,
All
sir.
right.
Okay, sir. Sir, I don't know how you get this 23. 25 minus 23 plus 1 divided. Okay. Thank you.
All right. So now this is for S1. For S2, it will be what? For S2, it will be what? To be 30 minus the base, that base value. And the base value will always be same, 23, plus what? Your dividend is what? 1.5 divided by what? The base. So when you solve this, you're going to have what? When we solve this, what will be our return? What will be our return?
Sir?
I'm with you, sir.
Okay, sir. Thank you, sir. Sir, I don't know. I'm just thinking something just come up. I'm just thinking that okay, my question is going this way that in a situation whereby the selling price is higher than the stock price, are we going to do the same way you are doing or another way around?
No, it will be same way. It will be negative.
Okay, sir. Okay, sir.
Yes, sir. To be negative. Don't worry. When time permits us today, you see different scenarios. Now, I'm just still coming up. So now, for the S3, we have it as what? 35 minus the base value, 23, plus what? The dividend is what? 2, divided by what? The base. When you do this, what will be the outcome? When you solve this, what will be your outcome? I need you to respond. You know, I'm not looking at
60.9%.
yes.
60.9%.
I'm not looking at the main platform. Should in case network knock me out, I will know it's network that make me not to hear you. So now we have 61%. But looking at this question, you can see that we've only determined the return. We have probability. Are we just going to leave our answers like this?
Thank you. I want to ask you a question.
The answer is no, because we have probability. So these are value of x. So x multiplied by 2 will give us our PS. Will give us our expected return. Will give us our expected return. So now for us to get our return, we're going to have the value of P is given. The value of X is what we've computed for. So what will be our PS? Our PS will be what? When the stock price is 25 naira, our return is what? Is 13%. Now our PS will be what? 0.25 multiplied by 13%. This will give us what? I need you to confirm what I'm doing. When the stock price is 13 naira, our return is what? 36.9%. Now, 0.5 multiplied by 36.9%, we're going to have what? Let me go and check what the people in this class.
18.45.
So I'm not getting response.
0.45.
18 points.
18.45.
Let's say 5. 45.
Yes, sir.
So when this is X, what is our return here? 61%.
On 15.25.
15.25. So overall, what would be your expected return? That is, you add everything there. What will be the value? It's 3.25. You have 37.7%.
36.95.
At the 6.95.
6.95.
All right. So what is the question, Madam Magdalene?
Sir, sorry, why did we use 36 here? My network threw me out for X3.
36 for X3.
The stock price is giving us 35 and we're using 36.
For X3?
Yes, X3, the last computation. Yes.
Okay, it's 35 rather. That's why I need your response. I need 35. So when you do that, I think you should still have same results.
Yes,
Yes.
sir.
So this is the various ways to determine your expected return in a way. So now the subject matter of today's class is on the issue of portfolio risk. Portfolio risk. On the issue of portfolio risk. Let me remove this this my formula, because some people will start getting scared. I don't want to scare anybody. Let me go and hide it somewhere. Some people will start looking, what is this again? I want us to derive the formula ourselves, do it together. Let me hide it here so that you will know that it's very simple. So when we talk about portfolio risk, we've defined risk over time in under risk and uncertainty. So risk is defined as the chance that an investment actual return will be different than expected. When your actual is different from your expected, that is possibility of risk. So this portfolio risk includes the possibility of losing some or all of your original investment. So portfolio risk is a measure of standard deviation. Take note, standard deviation. Let it be ringing in your head. Anytime we're talking about portfolio risk is standard deviation. And it can be minimized. Portfolio risk can be minimized through which way? Portfolio risk can be minimized through which way?
Diversification.
Diversification. Now, let me ask, the essence of having a portfolio is to minimize risk, isn't it? That when one stock is going down, the other stock should cushion the effects of the other by going up, so that you as an investor, you will not feel the risk as much. So when you have 100,000 today, instead of putting the whole 100,000 in with a single stock, you split it. That is where we are looking at weight the other day in our class. When you have a particular sum, you can split into different forms of it, so that when this particular stock is not doing well in the market, this should be doing fine. So that is the essence of portfolio. So when we talk about portfolio risk, we are looking at the issue of variance and standard deviation, because there's a link between variance and standard deviation. Because the square root of variance will give you standard deviation, and the square of standard deviation will give you what? Variance. The square of standard deviation will give you variance. Yes, what is the question?
Well done, sir. Please, not the question. Last slide, sir. Not a screenshot. I'm sorry.
Okay. I think, is this on? So when we talk about portfolio risk, we're talking about, all right, we're talking about issue of risk, which means uncertainty of return. And this uncertainty is measured using what? Variance and standard deviation. Variance and standard deviation. Variance and standard deviation. So I would like to ask, we have two types of risk. I'm asking because we've talked about issue of risk over time, even in when we're talking about cost of capital, we're talking about beta, we talk about risk. So we have two types of risk. What are those two types of risk?
Systematic
of
risk and unsystematic risk.
Unsystematic risk.
Fine. Systematic risk and unsystematic risk. So when we talk about systematic risk, this is a type of risk that affects the companies or businesses in the economy. It's a type of risk that affects all the companies or businesses in the economy. So it is a kind of risk that investors will like to pay for in order to avoid. So it is also known as general risk or non-diversifiable risk. That is the systematic risk. And what are the possible causes of systematic risk? We can have issue of economic recession, inflation. We can have political turmoil. We can have changes in interest rates. We can have terrorist attack. We can have pandemic. We can have war. These can cause systematic risk. Why unsystematic risk? This is a kind of risk that is peculiar to a particular company or industry. And I will recall, I said it can also be referred to as specific risk or unique risk. Unique risk. And the possible cause of this kind of risk can be your location. Your location. Your location. It can be the management of the organization. So these are risks that are particular or specific to the business, a particular type of business. So now, when we talk about variance measures how far returns are from their average value. So when we talk about variance, we're talking about deviation from the actual. It means you have a target, and when there is deviation, it means there is variance. So variance measure how far your actual is in relation to the average value. So when you want to measure variance, you look your actual results in comparison with the average. Variance which tell you that this is the extent of the variation. This is the extent of the variation. So a small variance means that return are close to average risk. Return are close. Yes, what is the question?
Sorry, sir. My question is that I'm trying to get this PS, and what I got is quite a difference.
Probability 0.25 multiplied by 13%. Do you have 3.25?
Sir, you say what, sir? 0. What, sir?
0.25 multiplied by 13%. Do you have 3.25?
Okay. Yeah. Yes. Okay.
So
Thank
when
you,
you
sir.
do it, you add everything, you should have 37%.
Okay, sir.
So we can have variance. The variance can be large, the variance can be small. So where the variance is close to the average, the actual is close to the average, it means the variance is not significant, it's small. But where the actual is far from the average, it means that the variance is high. So the question is, how do we compute variance? 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 Yes, what is the question?
Hello, sir. Can you hear me?
I can't hear you.
Hello, sir.
Yes, I'm
Can
with
you hear
you.
me now? Okay, sir. This
Yes.
0.25 times 13%. Can we calculate it as 0.25 times 0.13? Did you get the question?
Yes, you can do it. Once you get your result, you just multiply by 100 to have it in this way. Or you can, your total or your final figure, you can do it that way.
All right. Thank you, sir.
0.13, yes. So
All right.
how do we compute variance? How do we compute variance? How do we compute variance? There is this symbol. Let me get it. How do we compute variance? Variance. Okay. Variance. We can compute variance in this form. We can say summation P to the bracket of what? Of R minus what? Minus R bar. I believe you know how to write R bar. Do you know how to write R bar? Let me
Yes, sir.
see. That is R with a dash on it. R with a dash on it. That is R bar. R bar. I might not be able to get it on my screen. Let me see. Okay. Let's see. So R. Then up of it, you have a bar. R bar. R bar. Let me manage this way. So this computation will be squared, will be to the power of 2. Will be to the power of 2. If you remember your statistics, talking about variance. Talking about variance.
Hello, Mr. Tokwe.
Yes, ma'am.
The formula is R minus R bar. Abi?
Yes.
I'm not with you. Okay.
R minus R bar, everything in bracket to the power of 2.
Okay, sir.
To the power of 2. So the question is, what is your P? What is P? P is what? Probability. P is probability. And what is your R? R is what? Returns. R is returns. And your R bar will be what? Your R bar will be what? The R bar is your expected return. Your expected return. R bar is equal to your expected return. Expected return. Expected return. So now, this is variance. Variance measured what? Measure spread. It measure what? Spread. How far is your actual to the average? How close is your actual to the average? That is variance. That is variance. That is variance. So when you talk about variance, variance will lead you to what we call standard deviation. Now, what is standard deviation? The outcome of your variance when it is squared, when it is in square root, when you square your variance, square root of your variance is your standard deviation. Is your standard deviation. So standard deviation standard deviation is the square root. You know, there's a difference between square and square root. Is the square root of what? Of variance. Of variance. So once you get your results, once you get your variance results, when you square it, it will give you, when you apply the square root on it, to give you a standard deviation. So the square root of variance is standard deviation. Is standard deviation. Or you can say this value here into the square root will give you your standard deviation. We give you your standard deviation. I think I forwarded a question yesterday to the group also that we need to look out for. Let me see if I have the question here. The question on return variance. Let's see. I said from the table below. I don't know if you have access to the question. Okay. Maybe I didn't type it there. So let's take this question as an example to illustrate variance and standard deviation. So we have example. We have example. From the table below, compute the expected return. The expected return, variance, and standard deviation. Standard deviation. Variance and standard deviation. So we have states, we have probability, we have expected return. Expected returns. Now, when the states, when you're in the expansionary states, expansion, what is the probability? 0.25. The expected return is 5%. When the state is normal, you have a normal condition, probability is 0.5. The expected return is 15%. And where it is a recession state, the probability is what? 0.25. The expected return is 25%. The question is telling us that what we should compute the expected compute our expected return. What are we going to do? From our formula, the expected return is going to be what? So the expected return will be, first, we need to determine our expected return. And for you to determine your expected return, what are you going to do? It will be your summation of probability in relation to the returns. What we're trying to get the R bar, that is the S bar. So now your summation P in relation to R will be what? For each of the states. P multiplied by your R, when it is expansion, 0.25 multiplied by 5% will give you what? Multiplied by 5% will give us what?
1.25.
1.25. When it is normal, 0.5 multiplied by 15%.
7.5.
7.5. 0.25 multiplied by 25%.
6.25.
6.25. Now, what will be your R bar? Your R bar. Your R bar will be the summation of all your results here. Your R bar will be the summation of all the results here. So, your R bar will be what?
15.
R bar will be 15.
15.
15%. 15%. Now, this 15% is your expected return, is your EP, your expected return. From your expected return, you can move to what? To variance. You can move to what? To variance. Now, how will you move to your variance? How will you move to your variance? We said variance is what? Variance is deviation from average. Deviation from average. Now, if this is your average, this is your return. The relationship between 5% and 15% will be what? That is your R. Please, in your notes, right? As I'm saying it right, I might not be able to put the R bar. I didn't note, so R bar. Okay, let me just. Your R bar, R minus R bar. This is your R bar here. This is your R bar. This is your R bar. This is your R bar. So these are your R's. So R minus R bar. For expansion, your R is 5. Minus your R bar will give you what? That is 5% minus 15%. 5% minus 15% will give you what?
Minus 10. Minus 10.
Minus-
Minus 10%.
Minus 10%. Minus 10%. Then for normal, 15% minus 15%. That is R minus R bar to give you what?
0.
Minus 15%. You have it as 0. When it is recession, R minus R bar, that is 25% minus what? 15%. We give you what?
10%.
10%. 10%. So this is your R minus R bar. Now, to determine your variance, we'll still need to go further. That is this value here. You need to square this value, right? You need to
Yes,
square
sir.
it. You need to square it. you need to square it. So when you square this value, what will be the outcome? What are you going to square here? That is 10%. When you square 10%, the result will be what?
Minus 100. 100.
It will just be 100 because minus minus, isn't it?
Yes, sir.
Minus minus, when it is squared, it changes to positive. So this will be 100. When you square 0, to give you what?
0.
When you square 10, to give you what?
100.
100.
100.
Sorry, sir, I'm not understanding square 100, squared 0, square 100.
See the formula. This is the formula we're following. This is our variance formula. When you get your R is given. Your R bar is what you solve for. R minus R bar. Once you get this value, then you square before we now come to probability. So this is it. From the formula, your R given in the questions are this: 5%, 15%, 25%. Your R bar is what? What you solve for. That is 1.25 plus 7.5 plus 6.5. You have your R bar to be 15. So R minus R bar, 5% minus 15%, you have 10%. 15% minus 15%, you have 0. 25% minus 15%, you have 10%. From your formula, to get your variance, once you determine R minus R bar, you square each of the results. 10%, when you square minus 10, what will you have when you square it? To give you 100. When you square 0, what will you have? 0. When you square 10, what will you have? You have what? 100. I don't know if that is clear. Is that clear?
So sorry, sir, I don't know how to square it on my calculator here.
Sorry, I didn't get you, sir.
So I don't know how to square. I don't know how to square it. This thing.
Where is your calculator?
See it here.
Where is your calculator?
See it
Mr.
on my hand.
Shaibu.
See it on my hand here.
Oh yeah, on your calculator, press 1 and 0. Press 10.
1 0.
So you see a
Square
function.
root.
You see there are various functions to square. You see S square.
Okay, S square. Okay.
10x square. When you press that, you have 100. You have another option. Or you say 10 times 10.
Okay. Thank you,
S
sir.
square
Thank you, sir.
means 10 2 times.
Okay. Okay. Thank you, sir. I got it. God bless you.
So now, what will be the next step based on our formula? We've determined R minus R bar square. We are here to apply P. So when you say P multiplied by your R minus R bar square, what will you have? What will you have? So what is your P? Your probability? 0.
25.
25. 0.50 multiplied by 0 will give you what?
0.
0.25 multiplied by 100 will give you what?
25.
Your variance will be what?
50.
When you add 50. So this 50 is your variance.
Oh, what is causing like this now? This one now.
25.
If 50, you said?
Sorry, sir. I don't know why not. This is the last one that you just did now.
This is it, sir. Let me show one clear working.
Okay.
0.25 multiplied by 100. will give you 25. This probability here, see it's P.
Okay.
P. Let me
Okay, sir. Okay, sir. Thank you, sir.
square. So if this is your variance, if this is your variance, 50, what is your standard deviation?
7.07.
What is your standard deviation?
7.07. Square root of variance.
Will be what? Square root of variance. So on your calculator, when you do the square root, what will you have?
7.0.
7.07.
7, sorry. 7.1. 7.
7.1.
So 50, the square roots of 50 will give us equal to 7.0.
7.1.
And so on. Any question? Any question before we take it further? So we'll now move further. We'll move to covariance. 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 When we talk about covariance, covariance. Covariance. When we talk about covariance, these measures the linear relationship between two variables, between two variables. Between two variables. Now, covariance measures how two investments move. Take notes. It measures how two investments move together. That is, if stock A goes up, what happens to stock B?
Go down.
So covariance looks at the relationship between two investments. Between two investments. So it looks at what happened to investment A when investment B is going down. When investment B is going up, what happens to investment A. So there are three possible outcomes that we can draw out from the issue of covariance. We can have a case of positive covariance. We can have a case of negative covariance. We can have a case of zero covariance. So this covariance, it measures the direction of movement between two variables. Can be stocks, can be investments. So positive covariance, when we talk about positive covariance, what do we mean? Positive covariance. Positive covariance. Positive covariance. Positive covariance means two investments, two stocks, they are moving in the same direction. They are moving in the same what? Direction. That is, if stock A increases, what will happen to stock B?
Increase.
It will increase. That is positive covariance. That is positive covariance. Now, this form of investment is not good for diversification, because diversification is to minimize risks. By the time you have two forms of investment and they are moving in the same direction, once there is a risk on a particular stock, it will affect the other stock, because they are moving in the same line. They are moving in the same line. So positive covariance means both investments moves in the same direction. That is, if stock A increases, stock B also what? Increases. It means that the outcome is greater than zero. The outcome, once you do your computation and your result is greater than zero, it means it's a positive covariance. Positive covariance. Now, when we talk about negative covariance, what do we refer to? Negative covariance. Negative covariance. When we talk about negative covariance,
Where one investment is negative, the other one is positive.
yes, it means that the investment moves in opposite direction. In opposite direction. When stock A is going up, the value is going up, the value of stock B is going down. That is negative covariance. That is, your result is less than zero. When you compute and your result is less than zero, it means you have negative covariance. So this negative covariance is very good for diversification, because when one investment is going up, the other is going down. That is the essence of having a portfolio, so that one investment will act as a shock absorber to the other, so that you will not feel the effect of risk on a particular investment, since the other is there to cushion the effect of the fall in price of the other. So the negative covariance means investments in opposite direction. Now, when we talk about zero covariance means that the investment does not have any relationship. There is no relationship between stock A and stock B. So it means that you can invest in an umbrella business and going to invest in fish. Is there any relationship between these two investments? Unlike when you invest in raincoats, when you invest in raincoats and you invest in spark, is it spark wear they used to call it? Those of you that the females, you know, raincoats is to protect you from rain, right? And I think those spark wear is to make you enjoying fresh air, isn't it? It means by the time one is not selling, one should be selling. Or you invest in cold drinks, and in hot drinks. During the hot weather, the hot drink will not sell, but rather what we sell? The cold drinks. During the cold weather, the cold drink will not sell. What we sell? The hot drinks. So you can see when the sale of one is going down, the sale of the other will be going up. That is a case of negative covariance. But in the case of zero covariance, sorry, I'm putting zero investment here. Zero covariance. In the case of zero covariance, there is no relationship between the two investments you have in your portfolio. You are investing in clothing, and you are investing in food. There is no relationship between both. So zero covariance means that the investment does not have any relationship. That is, movement in stock A does not affect B. Movement in stock A does not affect B. Now, how do you compute covariance? How do you compute covariance? We have a formula to compute covariance. Covariance. Let's use two stock. It can be stock X and Y. It can be stock A and B. It can be anything, but just know the formula. Let's use A and B. Stock A and B. Stock A, covariance of stock A and B. How do you come about your results? Covariance of stock A and B. It will be summation. Please write this down in your book. It's very important. I will be going step by step till we arrive at a point, so that when we start solving questions, there will be no story. So it will be summation of P into the bracket of what? Please, as I'm saying it, be writing it. I want you to understand it. Into the bracket of return on asset A. Return on asset A. The A, you can make it a subscript. A subscript. That is, you can make it a subscript in this form. Yeah. Return on asset A. That is, we're trying to look at the covariance of two investments. Return on asset A minus what? The expected return. That is the return, the R bar. Take notes. Return on asset A minus what? The expected return of asset A. This expected return is the one with the bar. That is R bar and A. So you have it as you have it in this form. That is RA minus R bar A multiplied by what? Multiplied by what? Who can tell me what will happen? We're looking at investment A and B. So what will happen in the next bracket?
RB
Return on
minus
RB.
RB
Fine.
bar.
RB bar. So
R bar B or RB bar.
it's RB bar. Let me just copy. So you have it in this form. So this is covariance. This is covariance. Write it well in your book. When we start solving, I'll not get story. So what is P? P is what? Probability. P is probability. What is your RA?
Return on asset A.
Return on asset A. Return on asset A. So we have it, return on asset A. Return on asset A. What is your RA bar? Will be what? Your RA bar.
Expected return
Expected return
on
on
asset
asset.
A.
Yes, expected return of asset A. Of asset A. And same thing applies to RB and RB bar. RB is what? Return on asset B. RB bar is what? Expected return on asset B. Expected return on asset B. So now, this is covariance. Take notes. This is covariance. This is covariance. This is covariance. This is covariance. There is a relationship between covariance and correlation. There is a relationship between covariance and correlation. But the question is, what is correlation? You know, we define covariance as a measure of how two variables move together. Now, what is correlation? What is correlation? Correlation is not far from covariance, but there is just a single difference. There is a single difference between the two. Correlation measures strength and direction. Covariance measures what? Can I hear from you?
Relationship between
Strength and direction.
No.
Direction.
Covariance measures only direction.
relation.
Yes, relationship or direction. While correlation, it measures the strength. The strength. It measures the strength and what? It measures the strength and the direction. Why do I say correlation measures the strength and direction? For those of you doing research, by the time you use your SPSS to analyze your data, you'll be able to draw an inference from your outcome if your result is plus, minus, or zero. You'll be able to report that there is a relationship between your hypothesis, or there is no relationship between your null or alternate hypothesis, as the case may be, based on your results, on your correlation analysis. But based on this concept, we are saying correlation measures strength and direction of the relationship. Now, in correlation shows the relationship between two variables with the values of the variables ranging from either +1, 0, or -1. So when we have a positive correlation, let's come back to the screen. When we have a positive correlation, let's write correlation.
If you give us one.
Correlation. Correlation. You can have positive correlation, positive correlation, Now, when you have positive correlation, this is when two or more securities move upward and down together. They move upward and downward together in a portfolio. That is positive correlation. For example, shares in the same industry would have a high positive correlation, and they will be affected by similar events when you have your investment in one particular industry. So there is a perfect positive correlation when both investments move in the same direction, which means that the securities move shows that their relationship is +1. +1. So when you have a positive correlation, it means that the securities move in the same direction with a correlation coefficient of +1. When your outcome is positive from 1 above, it means that the interpretation of your result is what? Positive correlation. Positive correlation. Now, with this correlation coefficient of +1, it's telling you how strong the relationship is. It's telling us how strong the relationship is. So when you have +1 or anything above 1, it means there is a perfect positive relationship between the two stocks or investments. But when you have negative of 1, that is a case of negative correlation. Negative correlation. Negative correlation. What do we mean by this? What do we mean by this? Negative correlation occurs when two or more securities move inversely to each other, as we explained in covariance. Move inversely to each other. Move inversely to each other. That is, the two securities with negative correlation will be affected with different events. And this can help to minimize portfolio risk because they are moving in different directions. So there is a perfect negative correlation, which means that the two securities move in opposite direction and with a correlation coefficient of what? Of -1. So with correlation, you can easily define your results. But the limitation with covariance is that you cannot easily define your results. Either it is perfect or negative. But you can actually determine a result. If it is 22, you know the covariance is 22. But you cannot, that is one of the limitations of covariance. So correlation is a standardized way, of measuring the relationship and strength of two variables. So also you can have zero covariance, or zero correlation rather.
Correlation. We are talking of correlation, not correlation.
Zero correlation. You can have a case of zero correlation. When you have zero correlation, what is happening in this case? It means there is no relationship. It means there is zero relationship between two variables, between two investments. So the zero correlation occurs when there is no relationship between securities in a portfolio. So the result you get will be zero. In a question, you can be asked, you'll be given the correlation value to be +1, -1, 0. Then the examiner will want you to test what is the portfolio risk if the correlation is +1, if it is -1, if it is -0.5, if it is 0.5, and so on and so forth. So the relationship between covariance and correlation and standard deviation can be expressed using a formula. We can have it in this way. Covariance, we want to show the relationship between covariance, correlation coefficient, and standard deviation. We can show the relationship using this formula. Covariance of two security, let's say security X and Y, can be equal to correlation coefficient. I'll write it in full for now. Correlation coefficient of security X and Y, correlation coefficient of security X and Y, multiplied by what? Standard deviation. Standard deviation of what? Of security X.
X and Y.
Of security X. Multiply by what? Standard deviation of security
Y.
Y. Of security Y. Now, we can rewrite these in this form. Covariance of security X and Y can be equal to correlation coefficients can be put as RXY multiplied by what? Standard deviation of X and standard deviation of Y. It's standard deviation of X. Let's use this symbol. You know the symbol of standard deviation of X multiplied by what? Standard deviation of Y. So you can reduce it to this form. So the first one is just for you to understand what is happening, so that you not begin to say, this formula is long. Standard deviation of Y. Now, with this, can we make correlation coefficient subject of the formula? If you want to get your correlation coefficient, what will you do? You can make your correlation coefficient subject of the formula. And when you do that, what will be the outcome? Your correlation coefficient will be what? Yes, I need response. When you make this the subject of the formula, what will be the outcome?
To be covariance of S and Y divided by standard deviation S. than standard
Okay,
deviation.
very good.
Why?
I want you to say it with your mouth. So divide by standard deviation of x. Some people can say, this formula is something else. So I want to present it so that you know it's not any, there's not any big deal here. So you can have it this way. So your correlation coefficient can be covariance of xy divided by what? Standard deviation of x multiplied by standard deviation of what? Y. Please, is this formula clear?
Not yet, sir.
Not yet.
Sir, it's not clear at all.
So show me where it's not clear, ma.
From the beginning of the formula.
From beginning.
Yeah, not here. Sir, back to the.
Is it my network? Which beginning?
Yeah,
Is it from this page?
yes, this page.
Or from the
Yes, this page. Yes, sir. Yes, for me,
From-
it's from this covariance, sir.
yes. In this covariance, that's the relationship between stock X and Y can be expressed as what? The correlation of stock X and Y multiplied by the standard deviation of stock X multiplied by the standard deviation of Y. So covariance of security deviation of X multiplied by standard deviation of Y. Please, are you writing it in your book? Are you writing it?
Yes, sir. I've gotten it.
Okay,
sir.
fine. You've gotten it. So for you to get in based on this formula, you can make correlation coefficients subject of the formula. Why? Some questions, when we move further, when I present the portfolio risk formula, in some of the questions, there is a part of the portfolio risk formula whereby you can either use covariance or you use correlation coefficient. So the examiner can give you either of the two. And where you are not given, you can actually determine your correlation coefficient where certain variables are given. So for you to determine your correlation coefficient, you can make something else. So now this covariance of X,
Why? Kazu, who they of
this covariance of XY in your book, can you flip back to your book? Is there anywhere we show covariance of security A and B before now? Flip back to your book.
Yes, sir.
So for you to get covariance of XY, what is the formula? If you flip back to your book.
The formula is covariance of security A and B equals to summation P open bracket return of assets
What would be
A minus minus expected value of
yes? So you can see this is the covariance. It can be S and Y, it can be AB. So you can see this is presented to get covariance, to get covariance, to get covariance. So let's show some steps. Let's write some steps before we now pick an example to solve. So let's say steps to calculate correlation coefficient where there is probability.
Sir, I cannot hear you again.
Sorry, the network is actually showing me something else. So let's quickly look at the question to show these steps. Let's quickly look at the question. Now we have this question. The question is in your notebook already.
But you have not given us the step. Oh.
But we were not hearing you when you were talking of steps.
This is the step on the screen.
Please hold on, let's write. Mm.
Is this? Can we continue, please? Can we continue?
Yes.
Yes, sir.
All right. Stock X. We have stock current prices, expected return in 1 year with probability. We have the probability 30%, 50%, 20%. We have expected return. These are stock current prices. So we are looking at the possibility that in future the prices will be 66 for stock X, 92 for stock Y. In future, we are looking at the possibility of the price, the stock price to be what? 72 for stock X, and for stock Y, 104, and for stock X, 51, for stock Y, 62. Now, that's all these prices here. They are in. The question is, calculate the expected return and standard deviation for each stock over 1 year period. Calculate the correlation coefficient between the two stocks. Based on the requirement 1A, calculate the expected return. What are we going to do? Calculate the expected return. What are we going to do? You have the stock current prices, expected future prices, so based on this, is the holding period method. The holding period method. The holding period method is the method we are going to adopt to get what? Our returns. To get our returns. So based on the holding period, the formula is telling us what? The holding period. What is the formula?
P1 minus Q0 plus return all over P0.
Yes. So from this question, the P1 will be what? On this question, the P1 will be what? When your probability is 30%, your P1 will be what? 66. And your P0 will be what?
60.
60. That is so this is what we do for stock A or for stock for the question stock X. For stock X, I will solve for stock S. You solve for the other one. So for stock X, we can have X1. X1. So what will be the expected return in the case of X1? 66 minus what? Minus 60 divided by what? 60. Multiply by to be. You might not understand what we're doing at this point because we've shown this step before. We've shown
10.
this. Okay, fine. 10. So we have it as 10%. We have it as 10%. So in the case of X2, this will be our S2, 72. What will be your expected return? X2. What? 60 in form of percentage change. Multiply by 100
20%.
to be equal to what?
%.
20%.
What do you right? When it is X3, it will be what? 51 minus what? Minus 60 divided by what? 60.
Divided by 60.
Multiply by 100. You have it as what?
Minus 15%.
Minus 15%. Minus 15%. So based on these results, what will be the next step?
Why?
No, I'm not solving for Y. You solve for Y. We need to complete for stock X.
Probability.
Multiply by probability.
You multiply by probability, right?
Yes.
Yes, sir.
You multiply by probability. So this are when you multiply by probability. When it is X1, the probability is what? 30%.
0.30.
So we have it as what? 0.3
30%.
multiplied by 10% plus, when it is S2, it is what? 50 in relation to 20. So we have it as what? 0.5 multiplied by what?
80%. Second one, 30%.
20%. Plus what? Plus 20% multiplied by what? X. So this will give us what? Overall. This will give us what?
10%. 10%.
He said?
10%.
10%. 10%. So this will be your expected return. This will be your expected return. This will be your expected return, 10%. But we are asked to determine our standard deviation. How are we going to solve that? Standard deviation. How we our standard deviation?
We solve for variance.
Yeah. Any clue? Any clue to the standard deviation?
We are going to calculate
We'll set up
variance.
our table. Yes, calculate variance, probability. Then we're going to get our R bar, which we've actually derived. We've actually derived that by virtue of solving for A. That is your expected return. We've derived that already, but still, we are still going to show that R bar to get your variance, you still have to move R minus what? Minus your R bar. R minus R bar. What will be the next column? R minus R bar what?
Square.
Square. So you square this. R minus R bar square. Next column. Probability multiplied by R minus R bar square. So based on your return, what do you have? Based on your returns, you have 10, 20, and what?
Minus 15.
Minus 15. 10 is 10%, 20%, and minus 15%. Your probabilities, what do you have?
0.30.
0.3,
0.5.
0.5, 0.2,
0.2.
0.2. So your R will be what? 0.3 multiplied by 10%. You have what?
3.
0.5 multiplied by 20%.
10.
And 0.2 multiplied by minus 15.
Minus 3.
So your R bar will be what?
10%.
10%. So R minus R bar, that is this 10 here minus this 10 here, will give you what?
0.
20 here, which is R, minus R bar here, will give you what?
10.
Minus 15 here, minus 10 here will give you what?
5.
Minus 25.
5. Okay, 5.
Minus 25.
So when you now square these, each of these, based on this column, these will be what? 0 square, 0, 10 square,
100.
minus 25 square,
625.
625.
625.
Divided by r minus r bar square will give you what? This will be 0. So p multiplied by r minus r bar square, 0.5 multiplied by 100, 50. 0.2 multiplied by 625 will give you what?
125.
125.
125. Your variance will now be what?
175.
Variance will be 175. So what will be your standard deviation?
13.22.
23. 13.23.
13.2. Okay.
Yes, 13.23. Your standard deviation will be equal to the square root of variance which will be what? Which will be 13.23%. For stock Y, I think you can solve for that. Now the question is, what is the correlation? You can solve for stock Y, right? For these requirements A, you can solve for stock Y. I've solved for stock X, then you solve for stock Y. Now, calculate the correlation between the two stocks. Correlation between the two stocks. What is our formula for correlation? The formula for correlation is what? Correlation between the two stocks. So X and Y of X, the covariance of what will be the covariance of X and Y? What will be your formula for covariance of X and Y? Okay, because of time. The covariance of X and Y is stated above. This is it.
P.
Yes. This is it. This covariance here. There is a breakdown for it. That is what I'm asking of. What is the breakdown? This is the breakdown. So this is the breakdown. Now, for us to make this work easy, we can come up with a table. Yes, we can come up with a table to show, to analyze each of those variables. To analyze each of those variables of the covariance. Let's paste our formula here. Now, what is our P? What are the values of P in the question? We have 0.3, we we have what? 0.5. We have what? 0.2. Now, in the question, your Rx, return on X, what are the value of return on X? The value of return on X, that is, okay, we need to solve for Y.
Yes, sir.
We need to solve for Y. All right. So now, based on our formula, what is Rx minus Rx bar? We'll solve for Rx minus Rx bar, right? The outcome is what? This is the outcome. 0, 10, minus 25. 0, 10, minus 25. That is this aspect of the formula here. We'll solve for it while we're solving for X. So the outcome here will be what? This is 0. This is 10. And this is what? This is minus 25. The other part is this part that we've not solved for. Or you still solve for it now. So how are we going to determine our expected return and standard deviation for security Y? For security Y. What are we going to do? Security Y. Just follow this approach here. Stop Y. Return. Stop Y. Return. When it is Y1, what will be the change? 92 minus 80. When you go to the question, you have the question. Let's go and see it. 92 minus 80 divided by what?
80.
Divide by 80. When you multiply by 100, the result will be what?
15%.
So I expect you to solve very fast. Solve very fast. At least you should have known what to do by now. 15%. This should be solve very fast. This topic is very wide that I have to finish it today. And I'm not in my house. I need to conclude and go to my house. So I don't want to carry over this topic. So when you solve this, you have 30%. When it is so these will be what?
$22.5
Minus 22.5.
minus 22.
Okay. Minus 22.5%. That's 22.5%. Right. So what next are we going to do now?
Multiply the probability.
Multiply by the probability. Okay. Let me still use this point. Okay. 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 So now, based on our results, it will be what?
4.5. 15 and minus 4.5.
Okay. So the return 0.3 multiplied by what? 15%. Plus what? 0.5 multiplied by what? 30%. Plus what? 0.2 multiplied by what? Minus
22.5.
5%. So this will give you what?
15%.
15%. 15%. 15%. So give us 15%. So for us to get our standard deviation for stock Y, what are we going to do? Copy this. Standard deviation. Standard deviation for stock Y. Stock Y. The values of our R, we have them as what? This is 15%. This is what? 30%. And this is what? Minus 22.5%. Probability is same. The value of R will now be what? R bar, this will be what? 4.5.
15.
And this will be what?
4.5. Minus 4.5.
Plus or minus, you have 15.
15.
So your R minus R bar will be what? This will be 0.
0.
Minus 15.
15.
Minus 15.
15.
You have 15. And this will be what?
Minus 37.5.
7.5. So when you square this will be 0. This will be what? 225. This will be what? 1406. When you do this, P multiplied by R minus R bar square. Will be 115. And this will be what? 281.25. The variance will be what?
393.75.
And your standard deviation will now be what?
393.7.
19.84%.
Yeah, correct. Yes, 19.8. Yes,
So now, coming back to this, RY minus RY bar will be what? And what will solve? RY minus RY bar, that is this. 0, 15, 37.5. So you have it as 0, 15 minus 37.5. So this formula, what is the interpretation? Who can tell me the interpretation of this formula? It means what?
There's a positive correlation.
No, we've not gotten the answer yet, sir. I'm just asking. P into the bracket RS minus RX bar, close brackets, open brackets. Mathematically, what does this mean? Are we multiplying everything together or what?
Yes, we are multiplying. That's the summation of Yeah.
So this formula now, we want to see the climax of it. So the interpretation is P multiplied by 0 will give you what? P multiplied by, that is probability, multiplied by RS minus RS bar, multiplied by RY minus RY bar. That is everything in. This will give you what?
0.
0. So 0.5 multiplied by 10 multiplied by 15 will give you what?
75.
0.2 multiplied by minus 25 minus multiplied by minus 37.5 will give us what?
187.5.
187.5. Now, what will be your
187.
result? When you add everything, the result will be what? The covariance of X and Y. Will be equal to what? When you add
187.5.
75 plus 187.5 will give you what?
262.5.
262.5. So this is your covariance of X and Y. This is the covariance of X and Y. The covariance of X and Y. Coming back to the formula, you've derived covariance of X and Y. What is this? This is standard deviation of X, right? This is standard deviation of Y. Do you have them already?
Yes, sir.
Do you have? Fine.
Yes,
so
sir.
just for you to substitute. Just for us to substitute so that we can get our correlation coefficients. So based on this formula, our covariance of XY is what? 262 point what? 0.5. What is your standard deviation of X? Standard deviation of X is what? 13.23%. 13.23%. So you write 13.23. Multiply by what? Standard deviation of Y. You have it 19.84. 19.84. Multiply by what? 19.84. So when you do this, what will be the outcome? What will be the outcome? So these will be what? This will be 262.5 divided by what? When you multiply the two denominators, what do you have?
262.88.
0.4832. Confirm. Your correlation coefficient will now be what? Your correlation coefficient will be what? Your correlation coefficient will be what?
1.
1.000064.
64.
So what is the interpretation?
1.
What is the meaning of 1?
Interpretation means
Positive correlation.
is that when Y is increasing, X will be increasing. So it has a positive correlation.
Okay, fine. That is good. Let's move to the next point. Now we want to look at portfolio risk. portfolio risk. Portfolio risk. Portfolio risk. When we talk about portfolio risk, when we talk about portfolio risk, we're talking about the standard deviation of the portfolio. So the standard deviation is used to measure portfolio risk. And the higher the standard deviation, the higher the level of risk. So portfolio risk is denoted by this symbol. I think I have the symbol already. Is denoted by this portfolio risk. Is denoted by this symbol. Let me see it. More symbols. I've been using it, but the one I'm using is not. Let me search for symbol. Okay, I think this one is better. So this is the symbol for standard deviation. Standard deviation is denoted by this symbol. So portfolio risk is standard deviation or is expressed in this form. Expressed in this form. Expressed in this form. So when we talk about standard deviation of portfolio that is of more than 2 assets, we use a formula. I said that formula I display as at the beginning of the class is the formula, but I want us to write it together so that we understand the meaning of the formula rather than just seeing it. I know some of you have been seeing it. You've been wondering, how will I cram this thing? You don't need to cram it. So that is why I don't just want to show it. I want us to express it together so that it will make more meaning rather than just copying and paste. And the end result will be, this thing is serious. So for you to compute your portfolio risk, in portfolio risk, just take note, what you need is weight of the security and the standard deviation. Then your correlation coefficient or covariance, depending on the variable the question is given to you. So please take note, for portfolio risk, what you need is the weight of the individual securities and what? The standard deviation. The standard deviation. Now, how do you express weight? Let's use security X and Y as an example. Now, your portfolio risk formula will be the weight of security X. Please write weight of security X square. Weight of security X square. Weight of security X square. Like this. Weight of security X square. Multiply by what? Multiply by you can hear me.
Can
Hello,
hear
can you hear
you.
me? All
Yes.
right. So when you square standard deviation, what will you have?
Variance.
Very good, variance. When you square standard deviation, you have variance. So now, weight of security x square, it means the weight of security x, you square it. Multiply by what? By standard deviation of security x. Square of standard deviation of security x. That is this standard deviation for security x. What will happen to it? You square it. Okay. Still showing in superscript. So let me use this formula for my standard deviation. But this is the standard deviation. As you're writing in your book, you use the first expression. But let me use this for my standard deviation so that it will be very bold. Yes. So this square is standard deviation of x squared. Hope this is clear, please. Weight of security x squared multiplied by standard deviation of security x squared. You understand? Plus what will be the next thing? If you are using two securities, security x and y, what will be the next thing now?
Weight of security. Weight of security. Weight of security. Y
square. Weight of security y square. So weight of security y square, you have it weight of security y square multiply by what? Who can try?
standard deviation of security y square.
Standard
Yes.
deviation of security y.
Yes. It's better than me just presenting the formula. You now say, hey, this formula is something else. So it's not something else. So as we are saying it together, it's better. I'm doing this because last night some people say, how will I cram this thing? So I'm trying to build up on last year's experience or last diet experience. So standard deviation of security y square so once you have this, the next aspect of the formula will now be the aspect of correlation. Then you have plus 2 multiplied by the weight of security x. Now you are not squaring it. So you write plus 2 plus 2, that is, you have it this way, plus 2 multiplied by what? Weight of security X multiplied by what? Weight of security Y multiplied by what? Standard deviation of security what? Of security X multiplied by standard deviation of security what? Of security Y multiplied by what? The correlation coefficient. Correlation coefficient is expressed as what? R in relation to A and B. A and B. In some questions, this correlation can be covariance. What you just need to do, just substitute the covariance there in place of this RAB. So the formula for portfolio risk is weight of security X square multiplied by standard deviation of security X square plus weight of security Y square multiplied by standard deviation of security Y square plus 2 weight of security X multiplied by weight of security Y multiplied by standard deviation of security X multiplied by standard deviation of security Y in relation to what? Correlation coefficient of security X and Y, rather. X and Y. So security X and Y. If you are using security A and B, then it will be AB. If you are using X, Y, it will be security X and Y. Is there any problem with this formula?
Size long. Oh.
When you play with it like 3 times, you get it. By the time you close your eyes and just do it, okay, weight of security X square, you understand?
Yes, I cannot see the formula. It's blunt here.
Can you see it now?
Yes, sir.
So we have a question. I forwarded yesterday. I forwarded a question yesterday. So we are going to use that to solve this. We'll use that and apply this formula. Because if we didn't solve this one today, I will not be happy. I will not feel fulfilled. So I want to go home fulfilled so that I can discharge the necessary assignments I have. If I didn't give those assignments, I will not be happy. So let's quickly solve this. We have a question, right? This is a question. Yakubu is considering investing in 2 assets, asset A and B. Let me change it to, anyway, you can still leave it. I want to change it to X and Y. You can still leave it. Expected return of A, 12%. Expected return of B, 16%. Standard deviation of A, 10%. Standard deviation of B, 18%. In this question, they've helped us. They've even reduced the work for us. So the investor decides to invest 40% of their funds in asset A and 60% in asset B. Required, calculate the expected return of the portfolio, calculate the portfolio standard deviation under 3 different correlation coefficient scenarios. Scenario 1, perfect positive correlation of +1. Scenario 2, 0 correlation. Scenario 3, negative correlation, that is minus 0.4. So first and foremost, the expected return of the portfolio. This is very simple. Who can tell me what to do? Expected return of the portfolio. What are we going to do?
We had the 3. You had the three together.
Okay. Expected return of the portfolio. What is our formula for return on portfolio? You know, this portfolio now, not individual securities. They're asking us portfolio, return on portfolio.
Weight of security A plus weight of security B
Very good.
plus return of security B, rather.
Yeah. So expected return. Expected return. That is what we treated last week. Expected return on portfolio. Our formula will be what? That is
Weight of E, RP.
weight of
Weight of A
then plus what?
plus return. Weight of return B.
So from the question, do we have the weight of A?
Yes,
Let's go
sir.
to the question. The weight of A is what?
40%.
Very good. The investor decides to invest 40% of their funds in asset A and 60% in asset what? B. That is the proportion. So the weight of A is 40%. The weight of B is what?
60%.
60%.
60%. Now, what is return on A from the question? Do we have it?
Yes, sir. 12%.
12%. 12%. Return on B in the question, do we have it?
16%.
16%. So can you solve? Just solve and give me my answer. What is RP? Return on portfolio. What is the return on portfolio? The return on portfolio.
14.4.
14.4. Yes. 14.4. 14.4. So RP be equal to 14.4. So that is that for A part. The next, calculate the portfolio standard deviation under 3 different correlation coefficient scenarios. Now, portfolio standard deviation, which formula are we using? We are using this, right? Under 3 different scenarios. So portfolio
Where do you normally sleep in your room?
portfolio standard deviation. Portfolio standard deviation. Now, based on the question, we need to calculate the standard deviation when we have a perfect positive correlation of +1. It means part of the issue in this formula have been solved. Our correlation is expressed as what? RXY, right? Isn't it? Your correlation is what? RXY. RSY. Okay, this will change to A. This will change to A. Yes. This will change to B. This will change to B. This will change to A. This will change to B. This will change to A. And this will change to B. And this will change to A. This will change to AB. Change to AB. So your correlation, you know, you've been given the value of RAB. Isn't it, class? You've been given the value. You are given the value already, that when correlation coefficient is +1. So the question is this: what are we going to do? You have the variables to substitute into this formula already. You have the variables. So what is the weight of security A? What is the weight of security?
0.40. 40%.
Yes. 0.4. So the weight of security A, when you square it, that is what the question is telling you to do. When you square it, so now, so write out the formula and follow it. Let's follow it one after the other. Write out the formula. Let's follow it. If you don't follow it like that, you'll be seeing it like if it's a magic. It's not magic. I want you to get it so that you not see it as magic. Okay. So I change it to change it to A and B. Let's see. Okay, fine. So the weight of security A, according to the question, is what? 40%, right? 40%.
Yes, sir.
So 40% is what? 0.4 square. 0.4 square. 0.4 square. The standard deviation of security A is what?
10%.
Standard deviation of security A.
10%.
Let's go to the question.
10%.
10%. So when you write 10, what will happen? Square it, right?
0.10 square.
Yes. So the weight of B is what? The question.
60%.
60. So what will happen here? Let's put this in brackets. So this will be what? 0.62 square. The standard deviation is what? Standard deviation
18%.
for B, 18. You have it. That is 18%. I know some persons might be confused. That's why most times we use 18%. We are not writing 0.18. Yes. When you place one as a percentage and place one as a decimal, your final result will give you a percentage value. But if you can still write everything in percentage or in decimal, you still arrive at the same point. I know some persons are wondering that why is it that sometimes we express some figures in percentage and leave some in decimal. So 18 square, right? Plus the weight of security A is what? 2 is constant. So it's 2 multiplied by what? The weight of security A.
40%.
That is 0.4. The weight of security B is what?
60%. 0.6.
What is the standard deviation
10.
of security A?
10.
Standard deviation of security A. That is 10, right? 10. Right, 10. The standard deviation of security B is what?
18.
18. What is your correlation coefficient? Your correlation. Because the question is asking us, calculate the portfolio standard deviation under 3 different correlation coefficient scenarios. So we want to determine for scenario 1, where we have perfect positive correlation to be +1. So where it is +1, what will happen? This is our correlation value. So we replace RAB with what? With positive of 1.
+1.
That is the interpretation. So when you solve, what will be your portfolio risk? When you solve, this is scenario 1. What will be your results? What will be your results? Now, if you don't know how to press calculator, this is where the problem will come. So 0.4 square multiplied by 10 square, you know how you press it. You'll be writing your answer in one place. Oh yes, the story will be a very serious one. Okay, let me also try and break it down. Let's see what we can do. Let me break it down to this. When we multiply, this will give us 16 here. Then these points, we should have 116.64. This region here, I should have 86.4. .4. So what would be the outcome? What will be the outcome? 14.8%, right?
Yes, sir.
Press it to
14.8.
okay, fine. So this is for scenario 1 or for scenario 1. Yes. So what are we going to do for the next scenario 2? It's just for you to replace RAB with 0, isn't it? Replace RAB with 0. Then you solve again. Instead of having 1 here, you have 0 here. So 0 multiplied by all this region, it's going to be 0. So you now solve and get for this part. Then when you solve, what will be your outcome? For scenario 3, it's just for you to replace RAB with what? Minus 0.4. Then you see what will be the outcome. So the essence of doing this, the outcome with the least standard deviation, shows that will give us the combination with the least risk. It means that will be our decision. Any result with the lowest standard deviation.
10.8.
Scenario 2. Check that again, ma.
11.5.
Yes, 11.5. Scenario 2. 11.5. Scenario 2, 11.5. Scenario 2. Scenario 2, 11.5. Scenario 3 will be what?
Please show us the other page.
Ah, you're not writing.
Sir, I don't have lights.
Ah,
12.9, sir.
scenario 3.
12.9.
No, check it again, man. Scenario 3. People are not solving. Let me see what they put in this class.
6.8.
Magdalene. No, that is not the
6.8.
answer. That is not the answer.
Calculation.
Try again, man. Madam Licia, you joined late.
Yes, sir. I finished late at work, sir.
Madam Bridget, Magdalene, Esther.
Hello, sir.
Yes, ma.
The scenario 3, Shebi, it is -1 we are going to put here.
No, Umban. See it.
What is it?
Minus 0.4.
Okay.
Ma, you didn't check this question yesterday. Minus 0.4. So what will be our result? 9.9. Very good. 9.9. So
9.9.
yes, 9.9%. I define standard deviation that portfolio risk is standard deviation and is used to measure portfolio risk. And the higher the standard deviation, the higher the level of risk. So as an investor, based on these three scenarios, which would be your best point of decision?
14 points.
14 points.
First scenario.
So you like the one with the highest risk?
And now the higher the risk, the higher the return.
Okay, the higher the risk, the higher the return. But as an investor, you know, investors, all things being equal, they are rational. The investor would like to choose the one with the lowest risk and still get the highest return. That is how an investor will always reason. Though we know that the higher the risk, the higher the return. But still, the investor will still try to see how they can manage their risk by trying to go for the investment with the lowest risk, still with the hope that they will get the highest return, the best return from it. That is the rationale, that investors are rational in their decision making. Yes. If you look at the assumptions of capping, the assumptions of portfolio, is that you should go. The best combination for the organization will be that of scenario 3. Scenario 3, because when you compare the standard deviation Scenario 3 is having 9.9 compared to 11.52 of scenario 2, compared to 14.8% of scenario. I forwarded a question. These yes, today. The question is from the ICANN study pack. The question is from the ICANN study pack on alpha, on the issue of alpha and the issue of CAPM. Let me see. Let me go and locate the question in the group. I don't have it in my slide. That you have purchased the following data from an investment bank. I don't know if you have the question. Let me send it to my system. Do you have the question? Check the group. You see the question.
It's in the group.
Yes. Let me see if I can forward it to my system once. That you have purchased the following data from an investment bank, company A, B, C, D, forecast of total equity return, standard deviation of total equity return, covariance with market return. The market return and market standard deviation are 14.5% and 5% respectively. And the risk-free rate is 6%. Returns and all other data relate to a 1-year period. Required. Estimate the alpha for each of these company shares. Estimate the alpha for each of these company shares and explain what use alpha values might be to financial managers. The question is, what is alpha? What is alpha? That is ALPHA. What is alpha? What is alpha? Alpha is actual return or expected return minus computed return. Now, what is computed return? Computed return is your return that you derive using CAPM. Using CAPM. What is CAPM? CAPM is capital asset pricing model. While we're treating cost of capital, we talked about CAPM. The formula for CAPM is what? What is our formula for CAPM?
R risk-free minus beta open bracket RF, RM minus RF.
Okay. Yes.
Open bracket.
Risk-free plus beta asset equity bracket. Return on market minus R.
The formula should be in our head. That is, the CAPM formula is risk-free plus beta into the bracket of market return minus RF, where market return minus RF can also be referred to as what? Market premium. Market premium. That is premium. Premium. So now, looking at this question, when they talk about alpha, is the difference, please write, is the difference between your expected return, and your computed return. In the question, they'll give you expected return, the forecasted return. Then the computed return is the one you will use your CAPM to compute. So the difference between your expected return and your calculated return using CAPM will give you what we call alpha. We give you what we call alpha. Alpha. So expected return or forecasted return minus calculated return. The difference is what is termed as what? Alpha. 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 So I
Sorry,
want
sir,
us to
please, I
note
didn't get that. The difference
forecasted return. Forecasted return or expected return minus your computed return using CAPM. Using CAPM, capital asset pricing model. We give you what we call alpha. We give you alpha. We give you alpha. Now, this alpha is used to determine if a share is undervalued or overvalued. This alpha is used to determine if a share is undervalued or what? Overvalued. Is used to determine if a share is undervalued or is undervalued if it is performing better than expected. We're going to see the scenario very soon. And it is overvalued. When it is undervalued, it means it has a positive alpha. But when it is overvalued, it means it has a negative alpha. It means when it is overvalued, it is performing worse than expected. Performing worse than expected. So to compute your alpha, even though I've stated the formula, but let's see it. To compute your alpha, we say it is alpha is equal to forecasted return minus what? CAPM return. Let me put it this way, CAPM return. So you compare the return given to you in the question with a computed one. That is how you get your alpha. Your alpha. So the question is, if the security is performing good, are you going to sell or buy? Are you going to retain? So these are the questions or the reasons why you compute alpha. You compute alpha. So going through the question we have, in our on the platform. If you look at the question, you have forecast total equity return. Forecast total equity return. You have standard deviation of total equity return. You have covariance with market return. Covariance with market return. Now, based on this, how are we going to determine the variables required to solve this question? How are we going to determine the variables required to solve this? So now, the first thing we must do is, in the question, we need to determine our market variance. We need to determine our market variance. Let me just show this. We need the following. Forecast return. We need our risk-free. We need market return. we need what? We need our beta. Our beta. We need our beta. Where is our beta now? We need our beta. Now, how do you get beta? That is the major issue in this question. Because from the question, we don't have beta. There is no any story about beta. That is where the working is. How do you get beta? Please write. The formula to derive beta is covariance with market divided by market variance. Covariance with market divided by market variance. Covariance with market divided by market variance. Please write that in your book. Covariance with market divided by market variance. Covariance with market divided by market variance. That is how to derive your beta. Your beta. The question moves further. How do you determine your market variance? How do you determine your market variance? In the question, do you have market standard deviation? Look at the question. Do you have your market standard deviation?
Yes.
And what is it? 5%. See it. Market return and market standard deviation. Return is 14.5. That is the overall market. What you have here is for the individual companies. For the individual companies, for the market as a whole, what is your standard deviation? It is what? 5%. 5%. Now, you don't need the standard deviation. What do you need? You need the variance, right? From the formula I asked you to put down. You need the market variance. Now, if you have your standard deviation to be 5%, what will be your market variance? What will be your market variance?
25.
25.
25%.
Market variance will be 25. That is 5% square. When you square this, you have it as what? 25. 25. Now, for company A, please write this down. For company A, what will be the beta for company A? What will be the beta for company A? The formula for beta is what? Can somebody say it?
Covariance
Market.
with market over variance.
Over market variance. Over market variance. Now, for company A, what will be your beta? Company A, what will be your beta? Company A.
32% over. Okay.
1.28.
Beta for company A, which will be 1.28. That is 32 divided by what? 25.
25.
1.28. Now, beta for company B will be what? Beta for company B will be what? You know, the market covers everything. 25 will be constant for everything. So, beta for company B will be what?
0.76.
0.48.
0.76.
Yes, so it will be 19 divided by what? 25. 0.76. In that order, you solve for C and D. You solve for C and D. You solve for C and D. Now, since we have the beta for A, can we solve for our CAPM? Can we determine the CAPM? Now, using your CAPM, what is your formula? Is RF. Using your CAPM, your formula is what? RF plus what? Beta.
Okay.
Beta. Beta to the bracket of what? Market return minus what? Risk-free. Risk-free. Now, for A, what is your risk-free? In the question, what is our risk-free in the question? Let's go to the question.
6%.
Risk-free is 6%.
6%.
6%. So RF is what? 6%. Plus what? Your beta for A is what?
1.28.
1.28. Your market return is what?
14.5%.
14.5% minus what? Risk-free,
Minus
6.
6%.
So when you compute and you solve, what will be your outcome? When you solve, what will be your outcome? What will be your CAPM?
99.56.
Expected return for A should be 0. I'm not mistaken. Sorry. That will give us what? Your return will give us what? 16.88, not 0 as I've earlier mentioned.
61.88.
16.88.
16.88, right? What is your CAPM?
I got 61.88. It's
61.88.
61.88.
It's 16.88.
Hello, can you hear me? Right?
61.88.
61.88.
60.
16.
Yes, sir. 61.88.
16.88.
So this is your computed
16.88.
CAPM. This is your computed CAPM. When you go to the first return is what? See it, 16.88. 16.88. So what is the difference between your forecast and your computed CAPM? What is the difference?
There's no difference.
The difference is what?
0.
0. So your alpha will be equal to what?
0.
Your alpha will be equal to what?
0.
0. Your alpha will be equal to 0. The alpha is 0. All this is clear.
No. How did he get 16.88? though? I got 61.88.
Hello, is this clear, please?
Yes, sir.
So for company B, what will be your CAPM, computed CAPM now? Since you have your beta to be 0.76.
12.46.
The computed CAPM will be what?
12.46.
Okay, very good, 12.46. So if your computed CAPM is 12.46, compare with the computed one, the given one, forecasted one here, which is 12. What will be your alpha? 12 minus 12.46 will give us what?
It will give us
What will be your alpha?
0.46.
No, minus
46.
0.6.
46. 46. That is minus. Is it minus? Minus 0.46%. I don't know. Please confirm that.
Yes, sir.
So in that scenario,
So I'm lost though.
in that scenario, where are you lost, man? Because I need to round up and go.
Me.
16.88. I don't know how you got this 16.88.
Yes, sir. Because I got 61.88. So
14.5 minus 14.5 minus 6 multiplied by 1.28 plus 6.
Hello?
yes, sir.
Hello, can you hear me, please?
Yes, sir. We can hear you.
Yes, sir.
I can hear you, sir.
All right. I want to know. You said you are not clear somewhere, right? At what point?
Yeah. 16.88. But I've gotten it now.
Okay.
So I've
It's
not
clear,
gotten
right?
it, so
How did you get it?
Where? I need to go. I'm not solving.
16.88.
At
This
what point?
16.88. Me, I have 61.88. How do you get the 16.88, sir?
How do I get what?
Same here.
16.88.
16.88. I got 51.88. I've been asking.
Yes, sir.
I can't hear you. Is it 16.88?
Yes, sir. Yes, sir. How did you get it?
To get 6, what will you have? 14.5 minus 6. What will you have? Multiply that result by 1.28. And the result plus 6. You have to follow BODMAS. When you do that, you should have 16.88%.
Okay, sir. Got it.
Are you able to get that? All right. So for the alpha is what, please? The alpha. The alpha is what for company B? The alpha should be what we have in the question minus what? 12.46. The alpha should be
Minus 0.4.
is 46% or 0.46%.
Okay.
0.46%. I can hear you. So you compare what you have, what you computed, with what is given to you in the question. What do you have in the question as your return? 12%. When you use CAPM, what will be your outcome? Your outcome is what? Should be 12.46%. So the difference between your computed and what is given to you in the question is what? What is given to you in the question is less than what you computed. So what you computed is greater than what you have in the question. So it means the outcome The difference is what? Minus 0.46. Minus 0.46. So what is the interpretation? If what you computed is greater than what you have in the question, it means the asset, the stock, is overpriced. And when it is overpriced, it's an opportunity for you to sell and get more money. But where it is underpriced, it's an opportunity for you to buy and wait for when it will be overpriced for you to sell. So when it is underpriced, you quickly buy in the market and wait for the period when it will be overpriced. When it is overpriced, what do? The strategy is for you to sell. When it is underpriced, the strategy is for you to buy and wait for when it will be overpriced and sell. So when you look at there, then you see the analysis, the breakdown. But the breakdown I've shown to you is not in the solution, in the study pack. That is why I've decided to show you how to get beta. Beta is the constraint. So you get the beta for every other one for C and D. Then you solve and you see what has played out in that question. You see what has played out in that question. So go 299 and 300. You see this question there. So you see the solution likewise. But follow the analysis I've shown it to you. I'll forward the slide. Then you complete the solution. I will forward let me see if I have the assignment here. The assignment I want us to. So this is the assignment. Assignment 1 is related to the issue of portfolio risk. Yes, applying that our special formula. You have a portfolio of 2 stocks, A and B, like that. So assignment 1, please screenshot. You have assignment 2 likewise. You can screenshot. Sorry, I just have to go because
Sir, please show the 2. Yes, show the 2.
so you can make attempts to these questions, question 1 and 2. There are questions from Sima. That is